Hi, everyone. Welcome to this live TV show. As usual, I'm here to share with you my views of the market for this week. As you know, we have a lot from a macroeconomic point of view, not just because of calendar, but because of, now Donald Trump has begun, the new U.S. president. Let me share the calendar with you. Here we are. And as you know, the first measures he has been taking and the first word he has been given to the public had been quite disappointing because pretty much everything he said, he's reiterating his campaign speeches, right? And has given no clues about the upcoming tax cuts or infrastructure investment he has promised once he won the elections, right? So the market is fulfilled with uncertainty. Moreover, after right now, a few minutes ago, the Supreme Court in the UK has voted that the Parliament has to vote to approve the government's exit plan, right? The government will need to approve any kind of negotiation Theresa may want to do. And while most of the Parliament, both houses, are willing to respect the people's will, the fact is that we can see some opposition coming from descendant lover and mostly, I do believe, by Scottish nationalists, right? And I'm beginning to think that there's a possibility of another Scotland referendum, right, to leave the United Kingdom. We have one a couple of years ago. We may have another one these days. So everything on the matter is telling us that the Brexit, right, the beginning of a Brexit, in fact, which Theresa May wants to trigger by the end of March, will probably be delayed, right? So that will generate further uncertainty. Anyway, with Trump as US president, we are having a very weak dollar, and the situation seems to be persistent, meaning I don't see much of a case of a dollar recovery for this. So let's check the macroeconomic data and what we have ahead for this week, and then we will go to charts, okay? I was checking the preliminary market sector, market PMIs for Europe, and despite the European area, right, most of the countries have continued to grow during January. Seems to be a lot slowdown in the service sectors. Readings are really strong still, but are below market expectations. I don't believe that this is something that we should care of because it's not that the economy is shrinking, right? But there's a first sign of alert in there. But I believe that later today, attention would focus in the US PMI, right, and existing home sales. Remember, guys, as of lately, readings in the housing sector have been slightly below expectations, showing contraction, small retracement, but still failing to support the greenbacks, failing to support the case for a strong role in the United States. Housing sector is the one in trouble these days. Not employment, not inflation. I know the Fed bases its decisions in inflation and employment. Maybe the housing sector, you think it's not relevant, but don't forget that crisis back in 2007, 2008 was triggered by a collapse in the housing and mortgage sector. So these readings may be more relevant than what you think and may affect the greenback even further if we have negative numbers today, okay? For tomorrow, or for this Wednesday, right? Inflation in Australia will be the main market mover during the Asian session. The Aussie has been quite strong lately, mostly due to improving economic signs coming from China, right? China is the biggest importer of metals. Australia is one of the biggest producers. So and that's what's boosting the Aussie these days. However, inflation has been soft, to say the least, in the country. And given that Canada has said that with the uncertainty generated by Trump, they are willing to cut rates, I won't be surprised if a negative number in here puts the Reserve Bank of Australia in an alert, right? The Reserve Bank of Australia usually meets the first days of the month. I don't believe they will meet this next week because the month starts next Wednesday, but probably the next one. So beware of these inflation readings to affect the Aussie and therefore commodity-related currencies during the Asian session, right? Then I don't pay too much attention. The fact is that New Zealand inflation could be marked as 3, but it's hard that any figure coming from New Zealand can affect the rest of the market, right? So, well, if you're an Asian trader, you will like to take a look at this. And the concept for this is the same that it went for the Australian one, but it hardly affects the rest of the market, right? On Thursday, I do believe that the attention will center in GDP growth in the UK, okay? It's the preliminary reading for the last quarter of 2016. In general, the market is expecting some stability in here, given the data coming from those days has been quite stable. We have seen a small setback in data starting in December in the UK. So I don't know that a big disappointing in here could push a new turn in the pound, but I'm not expecting such a disappointment, not something like 0.2% or below. That would be a disappointment, which I'm not really expecting, okay? The other half of US PMIs will also be released on Thursday alongside with new home sales. Goes the same as we discussed. Inflation in Japan this week. The market hardly reacts to this news, but the fact that inflation belows within negative territory is a bit discouraging. Okay, we're not expecting much of a change in here, but neither we are expecting the Bank of Japan to refocus in inflation and these numbers. I do believe that they will hold on to their policy of zero or near to zero rates divergences. So mostly, I don't expect this to be much relevant unless we have big disappointments, okay? And finally, what I believe everyone is expecting on Friday, the first estimate of US GDP for the last quarter of 2016 is expected to have a downward revision. Sorry, it's not a downward revision. The third quarter final reading was 3.5%, and the economy is expected to have grown by 2.1% during the last quarter. So, despite it's well below the previous one, it's still a nice number, right? And anything above this level should help a bit the greenback to recover some ground, right? Anyway, let me change the charts, and we can see the levels to take care of these days. Here we are. Here's the euro. I have this Fibonacci retracement coming from the post-US election high around 12.99 down to this January low of 340. As you can see, the pair has been pretty much last week batting this 710 price zone, which stands for the 38.2% retracement of that movement. And it has broken higher, but still has faced a major resistance earlier today in the Asian session, which is the 100 simple moving average in that daily chart. So far, capping the upside around 770, right? The highs we have, moving average, above that level, moreover, if US data results disappointing, I could expect the pair to rally up to 800, 840. We have the 50% retracement around 820. In between 800 and 840, the pair has the huge long-term static resistance area. It has been the base of the range pretty much all through 2015 and 2016. So a break above that level will take more than dollar weakness. I do expect that if this region is reached, the pair will correct something lower, right? It won't be able to break the first attempt, at least that's what I'm thinking at this point, unless we have, I don't know, really huge disappointing news coming from the United States. Something I can't see. Besides, don't forget, the euro is still not a strong currency. The euro is still weak. The euro has still a lot to face this year with elections in France, um, and the growth figures that are slow, still slow. Remember what Draghi said last week, a positive inflation figure last December was not enough. They need to see more stability in inflation growth. So actually not expecting much more gains beyond that 800, 840 region. On the other hand, of course, the immediate support is that 700 price zone, which is the Fibonacci retracement. Below that, the pair has been finding some comfort around 650, 660. The next support for these days, 600 come next, and finally 565, which is the 23.6% retracement of that slide. Okay, I can see the dollar regaining some strength, more sustainable strength in the mean term, only on a break below this level. Okay, if this level holds, I don't see much of an upward potential for the greenback. And still, I don't see much of bearish trend right now coming from technical readings in intraday charts. In fact, everything's suggesting that the pair will probably continue advancing, at least at a slow pace, maybe towards that 800 region, but not much more. Okay. Sorry, let me go to the pound. There was some upward momentum going on in here, but after the court ruling, the market rethought that strength, and it's pushing the pound slightly lower. I still believe that this movement, this post-Theresa May Brexit announcement, it's corrective in the long view. And I believe that we discussed this, gains above 125 are unlikely to be sustained. And it's the last line in the sand where the selling interest will probably research something that's actually going on right now. Okay. I do believe that the immediate support and level to watch will be the 2410 20 region, because we have previous daily highs in that area, quite strong ones, but in general, right, in particular with bigger time frames, the movement seems pretty much an corrective movement. Nothing is telling me in here that the pair is ready to gain its upward strength, and that's the bottom in the pound. I believe we are far from that. And until the Brexit is triggered, the negotiations begin, I don't see much of a case for sustainable pound strength when we are going to see these corrections in the middle, at mostly range bound long term. Anyway, below that 24, 10, 20 region, pair can go down to 2360. Right there we go. We have multiple intraday highs and lows in the region, but I do believe that the key is 2330, strong, very strong static support level right now. It has contained the upside for over a month back in October, November, and it has been a tough level to break either to the upside or to the downside. So I could expect this level to hold, okay, at least this week. If it doesn't, then the risk will turn back towards downside, and the pair will have scope to test these lows, recent lows in the 2250 price zone, okay? I'm not daring to risk much of buying in here, to be honest. Above this high, the pair can extend a bit more. Okay, I'm looking for up to 26 probably, right? We have also strong static resistance area there. But I do believe that at this point, the market is more willing to sell the rallies than to buy the dips. So beware of that. I can't see a clear buy in the pound at this levels, okay? When it comes to the LC, well, we have breakthrough to this Fibonacci I had raw. We're at fresh 2-month highs in here, as I'd say. And I do support the case for a stronger LC. If you take a look at your charts, it has streamed almost every losses from the post-elections. Right, we are not far away from that. It's the one advancing the most against the greenback, against the commodity currencies. And I do expect this strength to hold, right? As we discussed in the latest coverage, the there's the risk that when the pair get closer to 77, the Reserve Bank of Australia will begin to get nervous and jawboning about the strength of the local currency. But actually, the market does not pay much of attention to those comments, right? And secondly, I don't see them cutting rates just because, or moving rates just because the Aussie is strong. However, keep in mind that if inflation readings this week disappoint, indeed, the Aussie will suffer, okay? Anyway, for the most bullish, I don't see much of a downward potential going on in here. The pair has traded as high as 76.08 so far today. So far, the gains above that 76.10 price zone will probably lead to an approach to the 77 region. Honestly, I do believe that that's the highest we can go this week. Not expecting much more upward momentum from this particular one. Not saying that the pair will reverse those levels, but pretty much thinking of some consolidation to take place around it. Okay, and until we get further clues, either coming from Australia or the US. The US is clueless. Anyway, if you take a look at this for our charts, around 75.50, the market has been willing to buy. So for me, that's the immediate support, followed by 75, 74.90. In fact, that's the level I'm watching. I do believe that it will take a break below this one to see the pair falling further. And in that case, 74.50, which is a major long-term, really big Fibonacci support and a strong static support level comes next. That's the level, the probable bottom for the pair in the case of a downward corrective movement. I would expect buyers to research around it and keep the downside limited, okay? And for the dollar Japanese yen, there was that wild recovery by the end of that last week, but the trend is bearish for me. I do expect further declines. We have, in fact, extended previous week lows by a few pips today. So honestly, I'm seeing some further slides ahead. It's true, we have this 100 simple moving average in the daily chart heading higher, and therefore offering a major long-term support, but that does not mean that the pair can go down to 100, which is where the moving average is extending. 1250, it's the immediate support. The pair has bounced so far a couple of times, so from there, weekly basis, so seems quite strong. I would take a look at this Fibonacci level around 1190. If the level gets up, we'll confirm the break lower and therefore signal a decline towards that region. To be honest, I don't see much of an upward potential as long as the price remains 1460. Okay, that's for me the level to watch. And even though above that level, the pair would need to surpass this previous week high around 1560, right? We have some sort of room in there to grab some pips towards the outside, but it will take some follow through beyond it to talk about amount bullish extension in here. And I can't see it right now. Remember, we talk about Japanese yen usually appreciating in February, despite the fiscal year rules on repatriation had changed around, 5 years ago, right? Anyway, the market tends to buy the Japanese yen ahead of the end of the fiscal year in Japan by March 30, okay? So usually February, March are months when the yen gains ground. And when it comes to oil prices, there's not much going on in here. It remains within a consolidative phase, right? We have that short-lived decline towards 50, but pretty much is holding about 52. To the optimism triggered by the OPEC with their output cut, right? Now we have a posting higher production in the U.S. There are several reports from the oil field companies saying that the U.S. it's rising its production and will keep on doing so starting February. So that is what's keeping the price contained. I do believe that we discussed many times the fact that there's not much upward potential beyond 55. I don't see it coming, to be honest. I don't see it either break below 50 unless we had bad news coming from the OPEC, meaning that the countries that have signed the deal to cut output begin to produce or export more. That would be bad news. And more production in the US, right? Or the other countries outside the OPEC. Not much, but there are others. So watch for those two factors to put the push the price lower. And of course, it will take a break below 50 to do so. But honestly, I'm seeing the oil holding in between the 50, 55 range for maybe a month more or so, a couple of weeks at least, okay? And finally, let's take a look at gold prices. The fact is that it's having pretty much the same behavior as the euro, right? We have an interim bottom, a relevant one, a corrective movement reaching the 38%, struggling around it, finally breaking, but again facing resistance around the 100 simple moving average in the daily charts, right? So technically, I do believe that chances for further gains in gold are less than within the common currency. Because at the end of the day, let's not forget that Janet Yellen has said that they are willing to raise rates a few times per year until they reach the 3% target by 2009, right? So that should keep gold prices limited. I don't discard the spike above those highs and even an advance up to this 1230, 33 region. Sorry, but that's the most I can see it advancing. I don't believe that the gold prices can go any further, and if they hold around this area until it's way too long to forecast, but if they hold in between 1150 and 1250, let's say, until June, when the Fed is expected to raise rates, then we will probably see a fall below these lows that we had late December, okay? But anyway, go to the short term. As I said, this 1220 region 16 is where we have the 100 simple moving average, and around 20 where we have the heights. So above this last rally up to 33 seems likely, but honestly not seeing much more coming from there. To the downside, the immediate support is 1210. Below that, we have this Fibonacci level, but to be honest, the price has not been respecting it much. We have some congestion moves in here, quite messy region. I will grab this low, right, around, okay, 1195.81, it says. So I could like the metal to break below this to talk about interim top and a probable break lower. And now that I'm watching this 4-hour charts, there's sort of a double roof going on in here with double top with the neckline around that 1195 level. Okay, $24. Hey, so the break should target 1170. Okay, region. Break below this level could probably end up going down there. But still, the 1200 price zone has been quite missing. Okay, so beware on a decline, wait for a confirmation until it falls below 1195. Okay, I believe that's it for today. Thanks for being here. Thanks for sharing your time with me. And I believe that I will see you next Friday with US GDP live coverage. I believe that Yohai and Mauricio will be with me as usual. So thank you and see you back then, okay? Thank you. Bye-bye.
topics. Lately, there have only been really two topics. We will start branching out again, but politics has certainly dominated the news flow and the market flow in the past 6 months, maybe a little more, since the British vote in June, on June 23rd. Today's topic is taken from a column that I did last week, titled "The Spotlight is Elsewhere, Mario Draghi and the ECB." I would say that for the next 6 months to a year, and probably longer, or possibly longer, the decisions and the greatest impact on what ECB policy will have, and therefore its monetary policy in Europe, will really not be determined anymore by the ECB. In other words, the ECB is not going to be in the position, I think, for the next 6 months to a year at least, to be deciding based what the policy in the European Union should be, the monetary policy, deciding based solely on economic factors in the ECB. In other words, what is good for the European economy? Do they need lower rates? Do they need more QE? Do they need higher rates? The basis of the EU policy, they were a bit tardy coming to the idea, but they've embraced it rather fully, is the same as the US. And that is that lower rates were necessary, that quantitative easing, the EU doesn't call it that, but that's what it is necessary to underpin the economy. There are two problems for the ECB. Well, let's go back a little bit further. I did a webinar with Boris Schlossberg from BK Management and Harry Dent, a well-known author, last week about the economic effect, if you will, of the Trump presidency, which of course no one knows. It just started. Actually, today was the first business day. And one of the points that I made, backed up by several other of the members of the panel, was that if you want to look at the long-term effect of interest rates, low interest rates and a zero-rate policy on an economy, then you don't have to speculate. You have the shining, although not so shiny, example of what Japan has tried to do in the past 20 years. If you ever needed a better example of why, or not even an example of why, but an example of the fact that low interest rates alone are incapable of promoting economic growth, then you have Japan. You don't really have to go any further. You can just look at the record in Japan for almost the past generation. So this is one of the ECB's problems. It turns out, I think, and certainly the proof will start coming in the forms of economic papers in the next number of years, as to what zero interest rates can actually accomplish and what they can't, what they have done. And this no longer is a speculative endeavor. It's an empirical endeavor. We have facts. We have statistics. We have things to be correlated and things to be looked at. And I trust that the academic economic community will begin to do this, so that in the future, aside from the politics, we will know the economics of what zero interest rates have done. Just on an observational and anecdotal level, it seems pretty obvious that whatever their positives effects are, one of them is not promoting strong economic growth. No place around the world that has used and currently is using very low interest rates have experienced strong economic growth. One would almost think that there is an inhibitor, as I do, within the lower end of the interest rate scale that inhibits, that prevents, or at least retards economic growth. It retards the types of business decisions, or delays them, that promote growth. So for the ECB, there are a myriad of problems heading out into this year. We are only on the 23rd of January. And almost everything, it seems, in the world and in the abeyance was held in abeyance for the inauguration of Mr. Donald Trump as president. Well, Mr. Trump is no longer president-elect. He is no longer Donald J. Trump. He is no longer the Donald, or anything else you would like to call him, depending on your politics, I guess. He is now the president of the United States. His decisions and his policies are about to become economic, business, political reality. We are moving from the realm of speculation and all sorts of other emotions to the realm of reality. And for the ECB, this is a twofold issue. There isn't a direct correlation in the sense that the ECB and its policies, the EMU and the Eurozone, were a direct target, or had a direct. Mr. Trump in his campaign did not speak very much about the ECB. He spoke about China, spoke about trade pact. But the two that he spoke about, the TPP, the Trans-Pacific Partnership, and NAFTA, the North American Free Trade Association area, I think, do not directly have the EU or the EMU as members. Nevertheless, the policies that he has illustrated that he will try and follow do, of course, impact what our trade is with Europe. However, so I think the two most important, obviously, the two most important factors external to the EU going forward for EU policy are going to be the policies of Theresa May, most important, and Donald Trump. But to take one step back, where is the EU and the ECB now, aside from the political stuff, which is going to be the main impact this year? What position is the ECB in vis-a-vis the European economy right now? Well, it is, unfortunately for them, not a very strong position. It has two components, and both are questionable at the moment from an economic point of view. One is zero rates, quantitative easing, they call it something else, have been insufficient to promote economic growth. The interesting fact is that the policies and the decline in interest rates have really been a response to political conditions more than economic conditions. Economic woes are hardly evenly distributed across the EMU, European Monetary Union, which, although it's not co-equal with the European Union, in a situation like this, I tend to use them interchangeably, which is not completely accurate, of course. Low interest rates from the ECB have not completely, but largely been a response to political events in the EU. Initially, although they were, of course, pretty much denied the fact that they would do this. I'm thinking, of course, of the Greek problem starting in, well, quite a few years ago now, in 2010, really. The ECB did not deliberately lower rates to prevent any problems coming from Greece. However, that has not been their response to the British vote to leave the Union back in June. There they have, most assuredly, lowered rates to do what they can to mitigate the circumstances that the EU fears will transpire when the British leave. Now, there, excuse me, there is little proof anywhere in the world that I can find, Japan, the United States, or the EU, that low rates promote economic growth. What they seem to do, hold on, let me just mention here, of course, the way we usually run these webinars. Anybody has any comments, questions, or any other thing they'd like to add, please type it into the chat. I am monitoring both the chat on the live video channel is where we get most of our comments. So if you have anything to say you'd like to add, please, and I'll address it. I prefer any commentary you can. It makes things much more interesting, I think, if people participate. But back to the topic. What is that? Just found something strange in my coffee. I don't know what it was. Whatever, let's put it this way. The ECB has largely fired all of its interest rate bullets. The gun is empty. They can reload it with even more program buying, but there's a big problem with that. They're running out of stuff to buy. And on the, I mean, talking about buying securities and bonds and things like that to lower rates. So the EU is heading into, and the ECB, what appears to be a year of potential turmoil without any real policy ammunition to utilize. And let's look at what we've got. In response to the Brexit vote, the ECB cut their interest rates to zero. Now, a sensible question would be, for all of these policies, why do they do it? Especially the latter policy, but you could say it's certainly of the United States and Bednarik. If you have Japan out there as a shining, but as I said, not shiny example of what can actually and what cannot be accomplished by zero rates over a long period of time, then why would you do this policy? Well, there are two reasons. One is policymakers looking at Japan will cite endless numbers of specific conditions which are specific to Japan that prevent Japan, or should prevent in their analysis, Japan from being used as any kind of paradigm for the policy of zero rates. I do not believe that's true, but I do believe that there are special circumstances in Japan, primarily the decline in population, that have blinded people to the degree of failure that's actually inherent in zero rate policies as economic policies, as policies to promote growth. So we can take it for a fact that nobody was looking at Japan, or whatever they were looking at, they were ignoring or making excuses for the evident failure of empirical, factual, right in front of your face based failure of zero rate and those types of policies in Japan to promote economic growth. Okay, so if we take the policy makers' position that Japan's a bad example and we're going to try it anyway, okay, we now have an example which will be much harder to ignore, and that is of the United States, where in order to maintain the idea that zero rates are a functioning and beneficial policy alternative, you can only do two things in the United States. One, which is the tack that the Fed has taken is that you simply say, well, things would have been worse. That's true, perhaps, but it's also unprovable. It is useless from any type of analytical point of view because it can't be answered. It's a counterfactual. It's theorizing. Nobody actually knows because it wasn't tried. So we can't say that as an exactly analogous situation exists where you could point to it and say, well, we had a really serious recession in a double-dip recession, actually in the early 80s when Ronald Reagan was president. And this is the result. We didn't follow these policies, we followed different policies. So economists are going to have to do the actual analysis and the comparison to come up with the mathematics that put fact behind what we've observed. I think it can and will be done. Whether it is going to be politically popular, I have my doubts, but certainly there will be academics out there who move in this direction with the analysis of what happened with the zero rate policy in the United States. The other response to it is the excuse policy, the one that's been used with Japan. This is sort of a part of the, and it's not entirely an excuse policy. There was that the Reinhart Rogoff book that came out about 4 years ago, saying that after balance sheet recessions like this, meaning that the consumer gets walloped and spends a number of years reducing their debt, and then a number of more years not spending up to potential because they remember what happened and they're concerned. This is the argument, and there's some truth to this. I don't know how you quantify it. I remember the attitude of my parents to stock market. My parents had no investments essentially for all their lives until the very end in the stock market, and the reason is because they both had lived through the U.S. Depression, and as far as they were concerned, the stock market was a casino, and they wanted no part of it. So these kinds of attitudes. Now, the Depression was a much more emotionally potent, especially because they were young. They were children and teenagers during the Depression, especially because, if you count it as, 10 years, 29 to 39, it's not quite fair, but it's because there was a very serious recession in 37. But it is true that there were far fewer support systems in those days. There was much less wealth in the country. And there were 3 years because of the depression, the stock market crash and depression began in 29. And Franklin Roosevelt, who was elected to improve things for the emotional need of hope, wasn't elected until 1932 and didn't take office until 1933. So there was a much longer period, I think, of thinking that the policies were failures and we need to do something about it. Here, the financial crash happened almost coincident with the 2008 election. And the policies, both of the Fed and the government, were phenomenally, or at least they thought they were, stimulative. So that excuse section why these policies were not as effective as they should, there's no question that the U.S. recovery from the financial crash and recession was both anemic by U.S. standards and quite effective by world comparative standards at the same time. So the ECB has examples. Wait, let's check what we have here. It has examples of the ineffectiveness of its current policies. So we'll just briefly talk about why is the ECB doing this. It's not a very large topic because they have to do something. This is an example of, I guess, the bureaucratic imperative to act when demanded, whether or not that act is going to have any long-term beneficial problems or effects or not. There is a pretty realistic concern that the level of the stock market, which has been really the prime beneficiary of the zero interest rates and quantitative easing policies here in the United States, and you have to say in Europe as well, is something that's ripe to fall because it is a bubble. It's certainly the current president of the United States has said that during his campaign, that he thought it was a bubble. I have two items on that. And again, this goes back to what the ECB has achieved and what is coming and what it can do about the political turmoil that seems to be headed its way. Central banks act and change interest rates because that's basically all they could do. You've heard this from me a number of times in my webinars and in the things that I've written and said. There is far less credit given to this idea than I think it deserves, because it and I know why, because it makes the oh dear, hold on a second, please. Excuse me for a moment. We had a slight crash here of the electronics. I have to make sure they, basically it sounds funny, but the computer just fell over. So I want to make sure that everything is still working. I think we are, but I just want to check. Okay, we're all still good. Okay, sorry about that. The computer actually fell over. Sorry about that. That was kind of funny. Anyway, where were we? So, sorry, I lost my train of thought. The ECB's problem heading into this year is essentially threefold, and it faces this year with two problems of its own. One is that the policy it's been following has not revived the European economies. There's very little growth in Europe, and it doesn't look like there's going to be any. Two, even within the context of that policy failure, which is how I view it, there is no more ammunition. In other words, what else is the ECB going to do? There isn't very much it can do. The experiment with zero rates and negative rates has pretty much ended. Not all of European sovereign rates have returned to the positive, but a large swath of them have. I actually didn't check that before I came in. So if Brexit negotiations, and you know, you can look at the potential for Brexit. Let's take a look at, this is the sterling we have here. I'm a little short of charts today. I apologize for that. We have switched information systems here. Okay, this is the euro. It is clear that the currency markets are taking the potential effect of Brexit almost as much out on the euro as they are on the sterling. Not entirely, of course, but there is a profound effect on the euro from the Brexit vote. It's over here. Okay, June, it's over here someplace. Okay, actually, it's right here. That's the Brexit vote right there. Okay, so the idea that this is a threat solely to Britain is nonsense. I mean, the Europeans are promoting this. The Brussels group, who support, the ever tighter union, are supporting this, but it's not true, and the markets are not buying it. There is, I think, as good an argument to be made for the idea that Brexit and the British leaving the Union will be good for the European economy, good for the British economy in the long run. I think personally it'll be good for the Europeans as well, because it will make them face reality. Then it will be damaging. So just on the face of it, the British departure from the European Union is being viewed by the markets, I think, as dangerous for Britain as it is as for the European Union. And in my mind, of course, it's not the market view, but in my mind, it is more dangerous for the European Union than it is for Britain. Second, we have the election of Donald Trump in the United States with his purportedly, at least in its effect, anti-trade rhetoric. Now, I do not believe that it is anti-trade rhetoric. It is, in fact, a request, a demand, to renegotiate trade agreements with the United States, and with what in view? Incorporating the idea of U.S. jobs into the picture. From a political point of view, you kind of wonder why this never happened in the first place, why these agreements and the people behind them were willing to essentially trade U.S. jobs for cheap consumer goods, because that's the essential trade. The argument is that both NAFTA and TPP reduce the cost of goods coming into the United States, and that is an overall benefit for the society that is laid against all of the jobs, the manufacturing jobs, which are lost. Now, this is the argument, the economic argument, the economic equation that has been supported by both the Democrats and Republicans here in the United States for a generation. The Trump revision of this is that you must include jobs in that equation. Well, if you start including jobs, U.S. jobs, in that equation, you end up with a very different balance. And that, I think, is the balance that he intends to try and redress. Now, how does this relate to Europe? In fact, it doesn't, or very little. Because whatever else you want to say about Europe, its products are not the result of a low-wage advantage. To take the first example, of course, Carrier, the American manufacturer of industrial equipment and refrigeration equipment, I believe, and many other things probably, did not move its jobs to Luxembourg, didn't move its factory to Germany, was going to move it to Mexico. So for this particular aspect relating to Europe and the ECB policy, and Britain, if you will, as well, both Britain and the EU and the EMU are largely high-wage, high-value-added exporters. If they're not, they can't compete. And it's even worse now under the euro. Germany is a high-value-added exporter. It can demand high prices for its products, because of their uniqueness and their quality and their sophistication. You could say the same about Britain. You can say the same about Italy, France, Finland, all of the other well-developed Northern European countries. It becomes less and less easy to say this about Greece and Portugal, to some degree Spain. For them, one of their advantages was low wage and the ability to devalue their currency, which is sort of the same thing. And that has been taken away from them under the euro. So the redress in the US and its trade policy of trade relations with other nations and other trading blocs to incorporate the idea of the effect of free trade is the wrong way to put it, of these trade agreements on jobs and wages in the United States does not affect the European Union very much. In fact, European manufacturers have moved some of their operations, I'm thinking primarily of German automobile manufacturers, to the United States. So that has actually been a trade. Now, American car manufacturers also manufacture in Europe. So there's a rough equivalence, I would say, of that particular exchange, economic exchange between the European Union and the United States. So Donald Trump's policy is not going to have that much effect. Theresa May's policies have to be examined within the context, I think, of two things in the European Union. One is the political rhetoric. The idea that if they're leaving, they must be punished. Well, there are two problems with that. One, that is an economic issue. If you start to punish Britain, then Britain's going to try and punish you back. If the idea of how to handle the Brexit, the departure, is to simply load up trade barriers on the southern side of the channel, well, what do you think the British are going to do on the northern side of the channel? They're going to do the same thing. So there's going to be a great deal of pressure within Europe from European manufacturers to try to mitigate this as much as possible. Now, Britain, I believe, sends 40-some-odd% of her exports to the European Union. The European Union's exports to Britain are not 40% of the European zone, of the Eurozone's exports. It's probably much closer to 15 or 20%. Nevertheless, if it is unbalanced, it still is a large and will be vocal share of economic growth in Europe that is tied to exports to Britain. So I don't think that the idea, now you have to separate, of course, the negotiating idea from the actual product of the negotiations. When you go into a negotiation, everybody stakes out the most extreme positions. Therefore, when they retreat from their positions, as they will, they end up more where they thought they were, or closer to what they hope will be their ultimate position. This hardly needs discussing. This particular principle of human life is illustrated almost every night in my own household with my children. We want to read before we go to bed. An hour. No, 5 minutes. So we end up at 15 minutes. They're only 8. So that's a normal process of negotiation. The second problem is far more profound, I think, and it's one which is slowly dawning, I think, on the European negotiators. The votes in Europe this year, internally, in the Netherlands and in France will be, I think, profoundly influenced by the coverage and the positions that the Europeans take vis-a-vis the Brexit negotiations. Now, as far as the British negotiations go, they are lucky in relation to the Dutch vote. The Dutch vote is in late March. The official negotiations will barely have gotten started at that time because Britain is, I believe, going to activate the Article 50 process in, I think they said in March, that's the last I've heard. So there won't be a great deal of commotion officially about the potential terms to affect the Dutch vote. As it stands now, Geert Wilders' party will be the largest in the polls now, would be the largest plurality, meaning that he has the largest number of votes, but not a majority. But the other parties, including the current ruling party, have said that they will not form a coalition with Wilders' party. So even if he gets 30% of the vote and then apportions the parliamentary membership as that vote would dictate, that's not a majority. And so the majority, the other parties would still have a chance to form a coalition government, which is what is in place there now. So it's not expected that even if Mr. Wilders' party does come out to be the largest party in the Dutch legislature, that he'll be able to form a government. However, it is my thinking that the more the British are punished, the more the EU is dictatorial and demanding and vengeful, if you will, in pursuing these negotiations, then the rest of Europe, I think, in the, not all of Europe, but the parties that are already lined up against Brussels, even if not immediately advocating departure, will have increased sway. One of the profound effects, I think, of the British vote has been the enabling of both rhetoric and potential and the shattering of the idea that the EU is inviolable. There are tremendous discontents in large parts of the continent. Some of it relates to immigration. Some of it relates to the lack of economic growth, which these parties will tie directly to the euro and to the European bureaucratic stultification that is coming out of Brussels. So the more aggressive, the more intransigent, the more dictatorial the EU appears in these negotiations, the greater ammunition, the more ammunition they provide to Wilders' party and Marine Le Pen's party in France, and although they have no vote scheduled, the Five-Star Movement in Italy, and perhaps even the German party, name of which I forget, which is recently formed. Germany is probably going to be the least potent anti-EU member, since Germany is by and large the greatest beneficiary of the EU, of the EMU, and that is because it keeps the euro at a far lower exchange rate than would normally be the case if the Germans were using the mark, and thus keeping German exports rolling. Okay, so on the one hand, for the EU, we have, or for the EMU, for the ECB, we have a policy which has been largely ineffective in creating growth because, in my mind, academic studies to come, zero rates cannot promote growth. Two, that even if they were an effective party, even if it was an effective policy, they're out of it. There's nothing else to do. They can't go more zero. They can go negative, but that's it. And the distortions from negative rates, I think even the central bankers of the world have recognized, are not worth the attempt. So on one hand, we have the ECB basically played out as far as its ability to exert influence on the European economies. We have this in the United States, the fount of modern quantitative easing. There is little, I know the Fed has been promoting this idea that we've reached full employment and therefore the rates need to go up. But there are little other indications that that's the case. If we were in a different world, take a hypothetical, and the US economic statistics of the past 3 years were the basis for Fed policy, but interest rates were at 3% on the 10-year or 3.5% or 4% rather than 0.75, would the Fed be considering raising rates? The answer is almost empirically no. So whatever the Fed says about its policies for raising rates, it's not because of economic statistics. It's because they're terrified there's going to be another recession. They're going to have nothing to do. Well, that's the situation that the ECB is in. So the Fed has clearly recognized that zero rate policies have their limits and you need to get out because there will be another recession. So the ECB is now constrained by the very promoters and originators of this modern zero rate quantitative easing policy. Okay. So if the ECB is one, stuck because it can't go any lower, and two, because it hasn't had any effect, and we have Brexit, the Dutch vote, the French vote, potential Italian vote, and a German vote, all pending this year. You know, we were watching, I listened to Mr. Draghi's press conference after the ECB decision not to do anything last week. And it was remarkably unremarkable. As I think I wrote in one of my pieces last week, gone are the heroic days of Mr. Draghi promising to do whatever was necessary to save the euro. Because there was very little that Draghi can do then or now to save the euro. The euro is largely a political endeavor, masquerading as economic policy. And the politics of this union are moving in a very dangerous direction for the Europeans. This is aside from the cultural fact. I mean, we do discuss this in the, I discussed this in the webinar with Boris and Harry Dent. The idea that what is the largest political entity that a population can feel sort of an emotional loyalty to. We are discovering, I think, in these early years of the 21st century, that the largest effective unit to gather in and benefit from the loyalties of its populations may in fact be the nation state. Something that certainly the Europeans and the European visionaries who founded the European Union thought would although the term I'm borrowing is from another context, of course, would wither away. That doesn't seem to be the case. We are seeing a series of movements, United States, Britain, and elsewhere on the continent, which I have mentioned, that directly refute this idea. Now, are the negotiators and the decision makers in Brussels, but also informed, of course, by the national governments, primarily of France and Germany, going to take the hard line with Britain in these circumstances? And I have my doubts. Now, it's all very well and good to use vindictive rhetoric. And we will not have anywhere near the final conclusion, of course, of the negotiations, because they're going to stretch on for at least a year before this comes about. I would think that one goal that the Europeans will have this year is to have as little impact as possible on European politics, European separatist politics, this year from these Brexit negotiations. The last thing, I think, that people who believe in the ever tighter European association represented by the European Union and the European Monetary Union would want would be the type of rhetoric that can be used by the European separatist parties to their benefit. And I'm thinking primarily of Geert Wilders' party and the National Front in France, and potentially the Five Star Movement in Italy. Britain has a history of separation from the continent, and it is physically separated. And that idea informs British politics and British strategic thinking, no matter who's in charge, basically since the Romans. That's not true on the continent, of course, but Europe has its own, continental Europe, I mean, its own history, which it is trying to avoid, of nationalist movements. So from here, I think this year, we are going to see, one, a far less vocal ECB, a far less effective ECB, although you can debate whether or not it's been effective. My idea, it hasn't been, because it can't be. Its policy tools, as in the United States, are faulty. In the sense, not that they're wrongly granted, but that they simply are not capable. They are outside their area of expertise, if you will, to use interest rates as an effective policy tool in this economic, I might even say cultural environment. So you'll see a less vocal ECB, you'll see a less effective ECB. In fact, I think that the European politicians who are ordering the events from the continental side for the Brexit negotiations are going to have to strike a very, very difficult balance this year between their desire to dissuade, because after all, what they're trying to do is dissuade. Punishment is ineffective as a tool in this situation. Punishment is effective for the Greeks because nobody there have a tiny little economy. Nobody really worried a great deal from a European point of view, from an EU point of view, from an EMU point of view, if the Greeks left the European Monetary Union. It wouldn't have had much effect. That is not true for the Netherlands, even though it's a relatively small country. Britain, France, or Italy. Punishment will not work. If they say, the Europeans say, the Brits, we are going to, you are out and you'll get no accommodation from us on trade, period. Okay. And then the next inference will be, and anyone else who attempts to leave the European Union will get the same type of harsh treatment. How is that going to play in a country like France or a country like Italy? Where in Italy, I think the youth unemployment rate below 35 is about 40 or 50%. Even in Spain, same thing, or in the Netherlands. So I don't think that the potential for punishment as a European prerogative to any party that leaves, that any country that attempts to leave the Union, is going to be very effective. Now, I don't know if the European negotiators and the European decision makers, including the Germans, of course, because if you're talking about France and you're talking about Italy and you're talking about the Netherlands, and you then talk about harsh EU tactics, there is only one place that that's going to be viewed as the origin. And it's not Luxembourg. It's Berlin. And as we all know, there is a very unfortunate history, and a long one, in Europe about this particular problem. And I don't think, even if it is screened and presented by the bureaucrats in Brussels and the European negotiators with Britain as a European-wide condemnation and intransigence on what Britain is trying to do here, once it then turns around and those same types of arguments and the same types of terms are turned on potential continental departures from the European Union and the EMU, the reaction, I think, will be profoundly different. The French are not going to want to be told by the Germans what to do, even if it is the Brussels bureaucrats speaking the words. The Italians are not going to want to hear what they must do or else from the Germans vis-a-vis Brussels. And I don't think the Dutch will be any more amenable to it either. So the ECB's policies this year are essentially paralyzed. The only thing I think they could actually do would be to reverse themselves, as the Fed has done, for whatever reason they want to say. Because in order to maintain an independence, which supposedly they are, and frankly, as in here in the United States, the idea that raising rates 0.25% twice a year is going to have a large negative effect on the economy is almost as silly as the idea, which everyone believes, that interest rates and negative rates will have a positive effect on the economy. It hasn't proven to be the case. What will happen if markets think that the Fed's rate program is going to be more dramatic than that, what will have an effect is if the credit markets then suddenly drive the rates much higher. So far, that has not happened. So back to where the ECB is this year and what they can do. As I said in a piece I wrote last week, the column, the spotlight is elsewhere. The spotlight for ECB policy is no longer in Frankfurt, where the ECB is. For the reasons I've spoken about, the ECB can't do very much. So it's going to matter far more for the future of the European Monetary Union what happens in the negotiations with Britain. It also is going to matter, though less than that, of course, what is the overall tone that comes out of the Trump administration? Although, again, as I've said, the specific trade topics between the United States and Europe are not that important. As far as the concerns of the evident election concerns of the Trump administration. And the other two items, which have not gotten much play or coverage, although I'm sure they're more covered in Europe, they certainly haven't here. The US media is obsessed with Donald Trump, and they're like ignoring everything else in the world. Is, of course, the Dutch vote, which is in March. Geert Wilders' platforms, or what he's said over the years, are to control immigration. I know it gets portrayed much more harshly in other venues, but that's where I'll put it. And to limit Brussels and EMU bureaucracy and their policies as much as possible within the Netherlands. That vote is going to be far more important to ECB policy, or at least the ECB's integration, not integration, the ECB's concerns than anything else. What if, remember, in some of the states that Mr. Trump won to swing the election to his side, the polling was off by 5 and 6%, well beyond the margin of error. Wisconsin, I believe, Mr. Trump was supposed to lose by 5 or 6 points, according to all the polls, the average of the polls. He won by 1%. A number of other states were like that. So we have to keep that in mind when we look at the run-up to the March election in the Netherlands. Is it not possible that instead of 25 or 26% of the vote that I think Mr. Wilders is polling right now, that he ends up at 35%? And even if that does not enable Mr. Wilders to form a government in the Netherlands, that will be a profound shock for the European bureaucratic structure in Brussels. So this is going to be the year, if you will, of the anti-EU, meaning not that they're all against the EU, but that you have to look, I mean EU, I meant ECB, sorry, that you must look to European politics and American international politics as well for clues to the future of the EU, the EMU, and the ECB. Because, as I said in the beginning, these three institutions are political institutions to a great degree, especially with the ECB masquerading as economic institutions. Okay, folks, I thank you very much for attending. I hope this has been of some entertainment value. We will do this again next week on Monday at 10 o'clock, as we do every week. I will try to avoid some of the topics we have covered rather at length over the past couple of months because there really had been no choice. And maybe we'll move on to some more strictly technical and currency topics. Again, I'd like to thank FXStreet for the facilities to do this. Everyone have a great day, and we will see you again next week. Take care. Damn it.